We get you some of the best voices across the world on markets and how to help you formulate your strategy as far as the market goes. Today, we've got someone joining in all the way from San Francisco, Dan Niles of AlphaOne Capital. Mr. Niles, of course, is getting a lot of international attention because of calling out the market correction timely. January onwards, AlphaOne Capital started to get cautious on the market. By March, clearly calling out a case for a correction, and we all know what subsequently happened. Dan, thank you very much for joining us on the show today, and that too all the way from San Francisco. Talk to us about the indicators which you saw, which you kind of called out the markets on the base of. What were those amber, when the lights turned from green to amber, that you saw that you called out the case for correction building in?
Well, I think there's a couple of things. As you pointed out, we were worried about the coronavirus back in January, and so in late January we started selling our stocks that we owned or hedging them, such as Disney, or we got very negative on Apple, which you can see on, I have a Twitter handle that I use, @DanielTNiles, and on it we talked on February 10th how we had started to short Apple because we thought there was a virus risk from China. And so obviously we all knew about the virus in China. People just chose to ignore it, which surprised me and didn't make much sense to me. So we tried to position ourselves appropriately because we thought eventually the U.S. market would start reacting to it as the virus continued to spread, and that's in fact what happened. And so that's kind of how we saw it. The data was there. You could see what was happening in China already. And so from that point of view, we just felt it was only a matter of time.
This is also a correction which was pretty swift. Investors and traders worldwide were not being able to, did not perhaps gauge it that suddenly the fall will get so accelerated. In these volatile times, how important is it for professional and personal money managers across the world to focus on risk management as much or perhaps a little more than generation of returns?
Yeah, I think it's more important than ever because the way the math works, and we've talked about this on our website where I post pretty frequently. It's danniles.com is the name of our website. And on it we talk about the fact that, look, if you lose 50% of your assets, you have to be up 100% to get to even. It's not being up 50. So to guard against losing money, that's really the key to making money over the long term. And so if you look at even this most recent correction in the S&P 500, you lost 34% from peak to trough. But what that means is you have to be up 52% to get back just to even. And so from that angle, trying to make sure you don't lose a lot of money, that's really the key to making money over a long period of time. And so what we really try to focus on very hard is not losing money. And that's why, as you noted, we can't talk about specific performance due to our fund's private registration, but for the month of March, we made money, and for the year, we made money through the end of March as well. So for us, the way we were able to do that is when the market was down 34%, we weren't down very much at all from the highs. And so that's how we're able to actually do well, is managing the risk on the downside.
There are a lot of Indian high net worth individuals who are keen on investing in the US markets. And US markets were having this 10-year massive rally, was not really giving opportunity for investors worldwide, including here in India, to invest because it was a big expansion. And now there has been a meaningful correction which has actually set in. What would you tell these investors, some of them in India, who are wanting to invest in the markets? Is the right time on valuation correction has happened in US? Should we start looking at that market favorably now? Or should we still be a little more cautious given how things are panning out?
Sure. I think, we're seeing a lot of interest. In fact, we've decided to open a second hedge fund, which does not meet the government required income and wealth minimums for our main hedge fund. We feel like everybody deserves the chance to protect their investments when markets get bad. And so, and this is only going to be open for about 99 investors, and we'll see if there's demand. But, I think the issue with trying to buy into the market right now is that you see bear market rallies. So in other words, when the market goes down a lot, you see these big moves higher, but then eventually the market goes back lower again. And you see this very consistently. If you go back to the Great Depression, which is a good example of this, you had 8 rallies in the S&P 500 that averaged 24%, on your way to losing 86% of your money. And if you look at the 9 prior times when the S&P has come down about 30% or greater, you've seen rallies that averaged 11% in the S&P 500 while you lost about 41%. And we have all this data on danniles.com if people want more. But, so these types of moves you've seen over the last 2 days where the market is up, high single digits in a couple of days. We obviously saw a period of time when the S&P went up 18% in 3 days. That's typical. It's something you should expect. The real thing I think people should focus on before they decide they want to invest in the U.S. markets, though, is, wait for earnings to come out. I mean, we were in an 11-year expansion, as you talked about. It's the longest expansion in history. In fact, the longest bull market in stocks in history. But stocks are still very expensive, and that's why I think it's prudent to wait at least until companies report and you see the extent of the damage. Sure. I think that's the key question you just asked. It's an excellent question. And I think when you look back at history, Mark Twain has a great quote, which is, history does not always repeat itself, but it often does rhyme. And I think if you look back at prior recessions and how long it took for stocks to find their ultimate bottom, if you look at the 9 prior times where the market went down about 30% or more, it took about 23 months to find the ultimate bottom in stock prices, so almost 2 years. And so as you stated in your question, does it take a couple of years? I think that is true. I think it'll take a couple of years. It's certainly not going to take 1 month when you have the dual shock of oil prices dropping a lot, as well as the virus, which is going to change things permanently in terms of supply chains and companies. A lot of companies are going to go out of business during this time. You had 6.6 million people filing for initial jobless claims last week, 3.3 million the week before. With that type of job loss and plus valuations still being very high, market cap to GDP, which is my favorite measure, is still around 1.1 times, and that's for the entire U.S. stock market. The average since 1970 is 0.8, so that's all obviously a lot lower than where we are today. I think when you look at all of those things together, I think, your statement, does this take a couple of years? I think 1 to 2 years at a minimum, that's sort of what you should be thinking about, not 1 month we figured out how bad this is going to be.
Right. Dan, thank you very much for joining us on the show today. It was great to have you on the channel.